welcome back. Okay, this is part 8 of chapter 4. Right, we were looking at doing a financial plan when the company is operating at less than full operating capacity. Less than full capacity. Therefore, when the company is operating at less than full capacity, then there is no increase in the financial asset. So we indicated that this will remain 5,000, and therefore this EFN will become negative 228. Okay, because there will be excess supply of financing. Excess financing. Alright, so let's go back to the slides here. Alright, so so we from that exercise we find that there will be excess financing of $222. Now, how do we address this excess financing? If it is negative 222 in your financial plan, it means excess financing. That means more than required financing. Okay, therefore, when it's positive, that means you require financing. When it's negative, it is excess financing, or more than what you need. Therefore, this excess funds or financing can be used to repay short-term debt, or to repay long-term debt, or to buy back shares. Share repurchase is also an option. You can use this excess financing to buy back shares. Or these are all external, external sources. I mean, you buy them back or you repay the loan. Or you can increase your dividend. When you pay more dividends, then you have less internal financing. So this excess financing can be used to pay more dividends, and therefore this will reduce the internal financing, the retained earnings. Or you can keep that as cash. You increase the cash account. Okay, that means the current assets will go up more than proportionate to the increase in sales. So all this will be able to address this excess financing. So when a company is operating at less than full capacity, as shown here, then this is likely to happen. Especially if the growth in sales is not very large, not very high. Okay, so let me just bring this to the center. Alright, Now we go to the next slide. Alright, so now we try and use the EFN formula. Okay, in this particular example where there is excess capacity, meaning the company is operating at less than full capacity. Right, so the information is still the same. The sales, current level of sales is 5,000. This is the same as the previous example. The growth rate in sales is 10%. The spontaneous liability level, the payables is 900. The net income for the current year is 1,185. Dividend payout ratio is 40%. And this is the formula that we have used before. This is equation number 10 that we have seen. The only difference now is this. The asset level, the spontaneous asset level now is 6,500. This is only the current assets, and fixed assets you don't include. Why? Because fixed assets, there is excess capacity. So the company need not increase fixed assets to increase the sales, but current account needs to be increased. Needs to increase in order to support the increase in sales. Alright, so therefore we change here. The only thing that we change is we don't take the full asset value. We take only the current asset value now. Alright, so we modify this. We modify this. In previous example, where the company was operating at full capacity, we took the full, or the total asset value. But here we take only the total current asset value. Alright, so we replace this. We change to 6,500 rather than the full amount of total assets previously. Alright, so this changes. When this changes, you find that the required total financing is only 650. Okay, and much lower than what it used to be. Yeah. Then some amount of financing given by spontaneous sources, that's payables. This is the same, no change. The internal financing provided by retained earnings, this is also the same, no change. The only difference is this becomes lower, yeah, than previously. Therefore, you have negative value. Yeah? This is less than the financing provided by the spontaneous source as well as the retained earnings, yeah, internal funding. Therefore, you have excess financing. Yeah? Negative 222, more precisely, is $222.10, but rounded to the nearest dollar, it is 222. Yeah? Now, this is how you can show. Yeah? The EFN formula can also be used in this case, but you have to modify. Yeah? When EFN using a company with operating at less than full capacity, then you have to look at, you have to change the asset value here. Yeah? You don't take the total assets, okay, but you take only the current assets. Yeah? Supposing that the fixed asset need not increase, yeah, to support the increase in sales. Alright, let's move on. Now we want to show this on this diagram. Yeah? We've seen this diagram before. These are all the same, yeah, right? Let me just bring this down so that you can get a full view. Right, yeah, now you can see the full view here. So this is the same, yeah, meaning the only difference is that now it's operating at 80% operating capacity. Yeah, previously it was operating at full capacity. The projected sales is the same, 5,500. The projected net income is the same. The dividend paid out, 40%, yeah, is the same. The dividend policy is the same. The retained earnings will be the same. Yeah. Now the spontaneous liability, okay, $90, the same as previously. The difference now is this. Yeah. Okay. Yeah. The difference now is this. Okay. You can see that only the current assets increase, yeah, not the fixed assets. Therefore, the change in assets will be 650. Alright, not 1,150, yeah, the $500 less. Alright, and then this must be equal to the increase in liability and equity. Yeah? But when you add these two, you find that it is much higher than 650. Yeah? Therefore, there will be excess financing, yeah? Negative 222. Yeah? So you can repay your debt, or you can repurchase your shares. Yeah, you can repurchase your equity. Okay, so in order to reduce this negative 222. Yeah, so this is how this figures, yeah, in this illustration. Yeah, when the company is operating at less than full capacity. All right. Now, what if we try and extend this example? Just now, the assumption was if the company was operating at 80% capacity. Yeah. Now let's see if the company is operating at 96% capacity. What will happen? Yeah. Again, you have the first step is always to compute the full capacity sales. Yeah, or FCS. So how do you compute this? You take the current sales divided by the capacity. Yeah, 96. Therefore, you get 5208.33. Yeah. Now note this, yeah, this means that this is the full capacity sales, meaning using the current, yeah, fixed assets, the company can generate maximum, yeah, $5,208.33. Beyond this, if they want to generate more sales, then the fixed assets need to be increased. Yeah, you need to increase your fixed assets. That's the idea behind this full capacity sales. Right, then the projected sales, okay, which is 5,500. Okay, we have seen that projected sales. Sales now is 5,000, but if it increases by 10%, it becomes 5,500 projected sales, and that projected sales is more than this, and therefore you know that there is a need to increase your fixed assets. But how much? Okay, now fixed assets will not increase by 10% because there is excess capacity now. Alright, now you have to compute the new level of needed assets. Okay, this is the formula. This is the new level, FA1, fixed assets. At year 1, you can put NFA, it doesn't matter. I use FA. reflecting net fixed assets. Yeah. So you take the current level of fixed assets, FA0. Let me just get the pointer. Okay, yeah. You get the FA at time 0, or fixed assets now, current level of fixed assets, divided by the full capacity sales. Yeah. Then multiplied by the projected level of sales. Yeah. So therefore it is 5,000 divided by $5,208.33. This is the full capacity sales, multiplied by 5,500. Yeah. So this is your new level of assets. Yeah? This is a simple formula. It's just a proportionate formula. Yeah. Alright. Yeah? FA per sales, new level of sales, must be equal to the current level of fixed assets divided by the full capacity sales. Because we have to look at the optimal relationship between assets and sales, and this is the optimal relationship. Okay, given this optimal relationship, if you need this much of sales, or you project to have this much of sales in the future, then you must have this level of fixed assets. Yeah? So it's a very simple proportionate formula. Yeah? There's no intrigue or mystery about this formula. Yeah? It's a very simple proportionate formula, so you need to understand this. Now this is the new level of assets. Yeah? So fixed assets must increase to 5,280. Right now the asset level is only 5,000. So there is a need to increase the level of fixed assets by 280. Yeah? This minus this 280. Now there is another way of computing this. Yeah? Note that the change in fixed assets, also this same formula here. This is the optimal relationship between fixed assets and sales, multiplied by the change in sales. Yeah? S1, this is the projected sales, minus the full capacity sales. Yeah? We must compute the full capacity, difference from the projected to the full capacity, not from SO. Yeah? Why? Because full capacity sales will be the sales level when you exhaust using the current level of fixed assets. Okay, if you use this formula or this formula minus this, you get the same answer. Yeah? The change in fixed assets will be 280. Yeah? $280. Okay, so that's the idea behind this. So EFN, how do you compute? Very simple, without going through the formula. Yeah? We know that 650 would be the increase in current assets, and then now we know that the fixed assets, an increase of 280 is required. Yeah? So these two together will be the increase in financing required to support the expected increase in sales. Yeah? So these two, okay, it is less than 1,150, yeah, slightly less than 1,150, but it's still more than 650, yeah, because there is a need to increase your fixed assets. Okay, so this is the total financing required to increase assets. Yeah? Then minus the spontaneous financing, $90, minus the internal funding provided by the retained earnings. So you get $57.9, yeah, or $57.90, or rounded to the nearest dollar, it will become $58. Okay, so this is how you solve that. Yeah. Now for Tasha Toy Emporium, if it is operating at 96% operating capacity, now all these are the same, yeah, right? Just like previously, if it was operating at 80% or operating at full capacity. Yeah, the difference here is again here, there will be a proportionate increase in current assets, but less than proportionate increase in fixed assets. So the total will be 930, not 1,150. Yeah. If it was proportionate increase in both current assets and fixed assets, the increase in assets will be 1,150. Right, that's the difference. So this should be equal to the change in liability and equity. When you add these two, you find that this is insufficient, not enough, these two, to attain 930. Therefore, external funding needed will be $58. When you add these three components, 1, 2, and 3, you get 930, and that will match this. Yeah. So if the company is operating at 96% capacity, then there will be some funding, external funding needed, either debt or equity. Yeah. So this is the solution for